on, guys? This is Dave, Bath and Beyond. We're all about mortgages and more. I hope
And
everyone's
more.
doing well.
Yes, everyone. Hi, good to see you guys. This is Bathsheba. I'm with Gross Capital, and we assist with Florida and other states as well. But mainly, I'm licensed in Florida. So give me a call for commercial, business, real estate. As in, you want to build a commercial property, I can assist with that as well.
And my name's David Dowd, and I own my own company, David James Investments. My brokerage is Equity Smart Home Loans. Currently, I'm licensed in Texas and California, but as time progresses, who knows, that may change. Always check the sites. But yeah, we deal with 150 different lenders that we can help get your loan started on a home or maybe even commercial. We'll see what's up. Today, we are going to be covering a couple bits of Fannie Mae guidelines. I'm going to just give you the fair warning that today, the recording is going down on September 29th, 2024. That's up there. And so if you're going to reference this video for anything that we are talking about when you're actually helping clients, if you're a loan officer or another loan professional, just be wary that the laws can change or the guidelines can change as well. So definitely always check the guidelines before making a decision. And I'm going to put a link right here to the guidelines we'll be referencing here as well. So with that in mind, let's go ahead and get it kicked off. I'm going to share my screen. To kick it off here, we've got loan limits. So let's jump right into that.
What is a loan limit? So Fannie Mae only will purchase a house for a certain amount. So for USA and like contiguous states like Florida, Texas, Georgia, the maximum amount they will pay for a house is $1,474,400. So, but if you're in Alaska, the Virgin Islands, they're willing to purchase up to $2,211,600. So that's a lot. Anything over that will be considered a larger loan. So they only want to focus on that amount and smaller. So that is what's the main focus of the loan limit overview.
So depending on where you're at, there will be a loan limit the Fannie Mae will require. And again, this goes back to many episodes in the past where we've talked about the cookie cutter idea. This still very much is in that way of thinking, where we only want specific loans for specific amounts before we'll purchase them, right? Fannie Mae will purchase those primary loans, always being in the first lien position. That's another thing to talk about here as well. That's going to be extremely important because they want to make sure it's going to be the least amount of risk. So they're getting paid first because it's the primary home, as we've also talked about in previous episodes. So yeah, the loan limits, very simple, very straightforward. They talk about that. Obviously, they have to be kind of general here because there are many places where the loans can be purchased. So like Bathsheba was saying, if you're in a higher area, you'll have a higher limit, and vice versa if you're in a lower area with a lower limit. And then they go into more details about that in coming parts here. And they also talk about modified loans, loan limits defined, and a quick overview. So that's basically what it covers. Very high level, very brief.
So anything outside of that amount of the loan limit is called a jumbo loan. So anything over the amount that I discussed is called a jumbo loan. And if you go into Fannie Mae, they do have a link, and that's where I was able to find the loan limit exact number as of today. The good news is that they increased that loan limit amount. So those who had loans that were around this price, maybe it was 1.3 million. Now that jumbo loan can be refinanced to a regular QM loan, which is a qualified mortgage loan, and get refinanced to Fannie Mae. And now you're under Fannie Mae's cookie cutter bracket for your home. So that's what I wanted to add too, because they did increase that loan limit size, which they do typically annually. They do increases. So you just have to be on the lookout, reach out to us or reach out to your local lender, real estate agent. They'll tell you what the loan limit is.
Jumbo loan, that's a term that gets thrown around a lot in the mortgage industry. And you're like, define jumbo. Well, it's going to vary, obviously, based on limits, based on laws, based on the lender's idea of a jumbo. But for the most part, it's just larger loans, right? You know, usually million, close to the $1 million area plus. That usually gets identified as jumbo and beyond for a lot of different lenders. So obviously that'll change over time, but jumbo loans getting refinanced, you know, into something that's a little bit more stable, maybe a better interest rate, maybe it's better loan terms, whatever it might be, because jumbo, they're obviously higher risk. So obviously we're limited on what we can offer there, interest rate wise, also term wise. That can sometimes be an issue for folks. So with the changing rules, always check to refinance, especially when the interest rates are starting to go down as they are now at this current time frame. So fingers crossed, we'll see them in the lower fives coming here in the next, few months, but we'll see
Yes.
what happens.
And it's great that it is going down. It's a great time. It's refinancing season. It's time to reach out to us if you want to get a refinance. You have an interest rate of 7.11. It's a great time to get a refinance to that 5-6%. So let's take advantage of these opportunities.
Potentially buying points. Obviously, your mileage may vary. Maybe that's a good financial decision. Maybe it's not. So let's always do the math beforehand. But yeah, interest rates are going down, and definitely reach out to us if we have questions. Now, this is a much bigger section we'll be covering here, the loan eligibility section, ability to repay the loan, acceptable loan terms, HOYEPA as it's called, impact of special assessments, premium pricing. That's an interesting one. Private transfer fee, covenants, age of loan, property value on loans sold more than 4 months from the note date, season loans, modified loans, and finally, non-standard payment collection options.
So let's talk about ability to repay. We remember ability to repay when we were studying for our exam, our SAFE exams. So ability to repay is a mortgage rate requires lenders good faith ability to repay the loan. So as a fiduciary, as we have to make sure our clients are able to pay back the loan. We don't want to get them into a loan that they're unable to pay. So they have 8 factors for the ability to repay, which is the ATR. And I had to go back to my old study guide to find it. I want to break it down because I thought that was very interesting and very important.
Nice.
So the first one is your current or reasonable expected income assets. So that's why we check your assets. We want to make sure that your assets are current. That's why we ask if you 2 years of income statements, your pay stubs, 6 months of pay stubs to make sure that you're still going to continue that line of work or you're still able to make that amount of money to pay for the home. Your current employment status, the borrower's credit history, want to make sure your credit history is up to par. So they look at the past to predict the future. The monthly mortgage payment for the loan to make sure you're able to pay for that loan, that there isn't any payment shock. Your monthly payment of any other loans, if you have other payments that you are paying, any installment loans that you're paying, you want to make sure of that. You're secured by property. If you have other properties or if the property is valuable enough or appraised enough for that money that they're borrowing, they want to make sure that property is good enough to get the money for the pay. The bank will give you the money for the home. That's where they do the appraisals. Monthly payments of property taxes and insurance. Hey, in Florida, taxes is just astronomical right now, so they want to make sure you're able to pay for that and make sure that you're able to afford that in the future, the next 30 years. If you have any other debts like alimony, child support, and your monthly debt to income ratio. So those are the 8 factors that they look at before they will consider giving you the loan.
So ability to repay, I think one of the lingering questions I had as I was reading this the initial time was like, why is this important beyond the lender? Because I get it for the customer, showing that you can pay for it will make you eligible. They'll likely approve you as an applicant to get a mortgage with said lender. But it's like, well, why would the borrower need to know that? Well, not so much they need to know. It's more so for the mortgage lender. It's more so for the folks that are giving the money. They don't have liability. Here's the thing. They're not held responsible if the ability to repay has been met according to how it's defined by Fannie Mae. So if Fannie Mae buys that loan, in other words, and there's a problem, and they documented the ability to repay of this particular client, this borrower, then the lender is not deemed responsible for the situation at hand. It's between Fannie Mae and the borrower at that point, if there truly was an issue. Maybe a misrepresentation, maybe there was, things that were submitted that weren't true, but the lender did their due diligence. And that's what this really is. It's due diligence, right? Ability to repay. Not only does it lower the risk, that's why it's such a big deal in all honesty when it comes to the like Fannie Mae, Freddie Mac, all those folks that buy the mortgages, but it also means that there won't be a liability. So you won't be held responsible, in other words, because I know it's a really technical term for those that have never been in the insurance gig. And that's really the big thing. You will be covered. Now, of course, all of this is covered in the federal law of Truth in Lending Act, or TILA.
TILA.
Regulation Z, the Godzilla. TILA, the Godzilla is how I was remembering.
Godzilla.
So it's some blue oyster cult up in here. That's the ability to repay in a nutshell. Obviously, there's a like Bathsheba was saying in more granular detail that they're looking at all those different things because a lot of people just think, oh, well, credit's the most important factor. Well, it's like, no, that's one of many factors when it comes to a mortgage because it's just so much money and so much time. It's both of those things. A lot of money, it's a lot of time. That's what entails in mortgages most of the time. So we're not only looking at your credit. That's one piece. We're also looking at, like everything Bathsheba was talking about. What's your job? Is there stability? How can we prove that income? Are you going to be able to afford this based on all your other debts? Like there's a much more, your job history, things like that, where they're much more stringent when it comes to that versus like maybe like a car loan or just a
Yes.
personal loan, things like that. So something to keep in mind when applying for a mortgage that it's, yeah, you got a great credit score. That's fantastic. Usually that means you've also got good habits instilled as well for a lot of folks. But in
Yes.
case that's not the case, you were just shooting for the credit score, but you had all these other bad habits, know that it won't help you in qualifying for the mortgage or being accepted by maybe a non-QM, that kind of thing. There are exemptions that it also mentions in there as well, as we can see, where it's exempt from the rule of ability to repay. And so it kind of goes over that very briefly. I think that's more of an outlier. Don't usually see that too often. Very specific. Most of the time, it's going to be ability to repay. And so your loan officer, whoever you work with, or maybe one of us, can go over more about what that means and get you more information if you need more of that.
I say that a lot. I say QM, non-QM. Non-QM is not a bad thing. It just means that it's not going to be purchased by Fannie Mae because Fannie Mae is a cookie cutter that David always pictures on our head. So now we know that QM is basically qualified mortgage. And what makes a mortgage qualified that Fannie Mae accepts? It's full documentation, going back to the ability, ATR, ability to repay. They want to make sure they have everything documented. Your points and fees cannot be exceed over 3%. Your debt to income ratio, it cannot exceed usually 43%. The maximum term of the loan is about 30 years. So that's what they're really looking at for a qualified mortgage, a QM, that they're willing to purchase. And for ATR exemptions, those are basically the loans not subject to TILA, which are DSCR, which is when you take out equity from your home to buy Airbnb property or a rental property, a business loan, a federal loan, organization and agriculture for organizational agricultural purposes. Those are usually the exemption loans.
To kind of give a high overview of that one, in case
Thank
no
you.
one's ever heard of the loan type before, it's
Right.
basically like you want to get an investment property and you want to verify your income utilizing what rents you would collect from renting out that place. A lot of times DSCR nowadays as a non-QM product is being utilized for that, for those real estate investors. Maybe there's other reasons as to why they're utilizing that. Perhaps maybe they've got too many loans, too many properties they have mortgages on, but they still want it. They got found a good deal and they still want to take advantage of that at that time. They have the margin, they have the money to do so, but qualified mortgages isn't going to cut it because I know Fannie Mae has a limit. I think it's like 10 loans total that you can have
Right.
with Fannie Mae. I don't know if that's and Fannie Mae and Freddie Mac. It's like 10-10. I'm not 100% on that one, but I know Fannie Mae's for sure is like 10 maximum that they
Mm-hmm.
can buy under one person, residential real estate anyway. Remember, all of this, Fannie Mae is only doing residential for the most part. I don't believe they do any commercial. And if they do, I'm sure they're going to tell us, but I haven't
Right.
read anything about commercial just yet. So within the product, given how different that could be.
Points and fees. They just want to make sure that your points do not exceed a certain amount. For the points, your points cannot and your fees cannot exceed 3% of your total loan based upon Regulation Z. It's also based upon the QM. So they just want to make sure that again that your fees are not exceeding over 3%. So when they do your loan estimate and they look at your points and fees and they add that up, if that is exceeding that, then it's like, hey, we're jumping into POIPA and high price loans or high price costs, which we're gonna touch on here as well.
Definitely always be careful, especially when
Yeah.
you're shopping lenders as a borrower. If you're going to be a savvy borrower, you want to look at those points and fees. You want to make sure they make sense, and know that that's how we as loan professionals we are going to be making our income from those points and those fees.
Right.
So you'll see that the origination fee, that's pretty much where we're getting where we're going to make our bread, so to speak, from the
Yes.
process. So if you're ever wondering, well, how do you guys get paid? Well, yeah, look for points and
Yes.
fees, and you'll see that their origination fee, that's us. So that's a big part of it. And the fees are always going to be a thing. Any investment you ever do, always look for the lowest possible fees. And if there are going to be fees, understand why. I think that's really important. Talk to your loan
Yes.
officer about that and make sure you've got a good understanding. If they don't know, they can find out for you. That's usually how that goes. And then you have a better idea. And just know that there will be fees because this is a process that involves many different people in order to get you that mortgage on that home and even the home itself, right? Like the
Right.
appraisers and the inspections and things like that. So just keep that
Yes.
in mind as you go through your home buying process. And then it jumps into, was it APR and APOR?
Yes.
But it doesn't actually define what APOR is for, everybody else. So, APR, of course, is annual percentage rate. And then
Yes.
APOR is the average prime
Prime
offer
offer
rate.
rate. Yes.
Yeah. Yeah. So that can get a little confusing. No, it's related to markets and how that relates to how we're supposed to determine interest rates and stuff for people beyond whatever the interest rate is. It's like, well, that's the interest rate, sure, but it doesn't include all these other things. And then all the other things part, that's what the APR is supposed to capture. So just so we understand a little bit about that too.
Forearm, the initial fixed period of 5 years or less. Right now, we're on acceptable loan terms. That goes into the QM again, making sure that it's within about 30 years. That's how typically they want the loans to be for a long period, 15 to 30 years. And that's about it for that process.
Yeah, I think it says 85 months right here, the minimum
Right.
original term, and that's about 7 years. If I did the math
Mhm.
there, it's about 7 years. So actually, you could get a 7-year loan. I don't recommend it,
Wow.
but you could do that. So if you knew you were going to have like a windfall of money in like, I don't know, 5 years, maybe that's a good
Right.
idea. Maybe that's not. Your mileage may vary, but yeah, acceptable loan terms, the 30 years, as Bathsheba was talking about, it tends to be the gist. That's what they even call the traditional product. I think the only thing that's traditional is a
Right.
30-year fixed loan. So just so we could get a little bit of context there as well.
HOEPA stands for Home Ownership and Equity Protection Act of 1994. Section 32 of Regulation Z is not eligible for delivery for Fannie Mae and is not eligible for delivery to Fannie Mae as well. So that's again, the purpose of this is to stop deception pricing when the interest rate, those fees are way too high, and they want to make sure that the lender understands that.
Yeah.
Perhaps you're just buying a house temporarily and then you're looking to refinance it, or you do an arms. We talked about arms before, and then the arms is gonna jump and get that payment shot. They want to make sure you're able to afford it, because they're gonna go back and if it's been a year and then now you're in for less than a year and you're in trying to get foreclosure, you're in the process of foreclosing. They're gonna ask what happened. Were you informed of this? Did you agree to this? Were you coerced? They're gonna want to ask that because they're not going to want to pay that.
Whenever I see HOIPA, I just think high price.
Yes.
Yes, protecting people with high price situations because in the financial industry, unfortunately, people put themselves in deep water and they don't know it.
Yes.
Because
Yeah.
there's a lot of terms, there's a lot of conditions, there's a lot of guidelines. And most of the time, they're not going to read that stuff. And that's understandable because it's a lot. And it's a lot of fine print, it's a lot of legalese. That's not fun to read. It puts me to sleep, things like that.
Yes.
But then it goes into this huge state list of applicable states where they define how they define it in those states, which is
Yes.
really interesting. I haven't seen this since my insurance days, but there are
Mm.
some states where, for example, comprehensive coverage, they don't call it comprehensive coverage in certain states. They call it non-collision. I'm
Oh,
like,
yes.
I don't know why you guys do that, but that's what they do. I guess it's because there's some legalese and maybe something else that's too similar and it gets confusing, so they have to call it something else. I think it's Virginia they call that. The
Mm.
non-collision is the comprehensive, or there's different terms. So that's what this reminded me of. Like, for example, Arkansas calls it high cost home loan. I think a lot of them call it the high cost home loan, but Georgia just calls it a home loan.
Home loan.
I'm like, all right, great. That's not very specific. But then as you see, high risk, Illinois, high risk home loan. They take it a step further. I think that's
Right.
probably better defined. High cost home loans, a lot of them, like you can see, high rate, high fee mortgage. So there's a lot of
Mhm.
different versions of the same thing. They all mean the same thing, but they just in that state for whatever reason, that's why they call it that. That's how they define it there. So just be privy to that and maybe call it something different in your state. I think there's the only ones I'm not really sure if it's not on this list, if it just means that it's some other default. Maybe it's
Right.
I don't know if it's like Georgia where it's home loan or it's some sort of high loan, high cost home loan.
So basically with the whole, they want to see, why would you want to spend more money when the rates are good right now? Why would you want to spend 7.5 on a home loan when right now it's about 6% or 5%? You know, they want to make sure that you're not being swindled. So that's why they put that in there. And we have to remember that the reason why there are so many laws is because an incident happened and they learned from it and it became a law.
Yeah.
So
Unfortunately.
unfortunately, something happened, and a lot of people probably in 2008. Well, this one said 1994.
Yeah.
So back in 1994, maybe 1990, something happened. There was an influx of people losing their home, and they did the investigation. They're saying, "Hey, who is pocketing from this 0.32% difference?" And then they realized that, okay, this is something going on, and they made a law into it to
That's right.
protect the consumers. So
That's right. Every time there's a law, there's always a story behind that law.
yes,
It's usually not one. It's usually not just
usually
one.
not
So,
one.
especially with the
Yes.
mortgage industry, my gosh, I feel bad.
Yes,
A lot
one
of
doesn't
people.
get attention.
Yeah, it's like if you're going to get in this really risky, high, expensive loan, you need to make sure you understand that. That's what HOPA is mainly created for.
Yes.
And I think as loan professionals, it's really our duty to make sure you understand that. Now, you make the choice you want at the end of the day. So
Yes.
even if it's a bad financial decision, like from my opinion, if you will, that doesn't
Right.
matter. It's your choice. It's your personal financial situation. So
Right.
know that too. You shouldn't be forced to make a decision like that if you don't want to. See about the
Yeah.
impact of special assessments on maximum loan amount, these maximum loan amounts that we talked about in the previous section, and what are some of the exceptions to that rule. There may be some very, very few, but also like what are the conditions as to
Yes.
why they would accept those exceptions. It talks about that there. The
Mm.
properties, liens for taxes and
Yes.
special assessments, and liens
Right.
not yet due and payable, things like that. It gets really into the weeds.
A lien is basically when somebody does services to your home and you haven't paid them, so they put the lien on the house so they can get paid,
Mhm.
or something against the property and then they want to get paid. So if there's some, or you haven't paid your taxes, so there's a lien on it. So they're talking basically about that, those special assessments.
Yeah, it's like a stacking of debt against
Yes.
a certain thing. So
Right.
you'll see it probably a lot more in the car industry where they say like the lien holder of the vehicle if you're financing, and that's just the
Yes.
person who is financing the vehicle who needs to show up on the documentation. And in the mortgage industry, you'll see liens with an S a lot of the times, especially when you get into fancy, which we're getting into premium pricing here in a second, but when you get into
Mhm.
fancy financing and creative financing, as it's also called, you'll see that, you know,
Yes.
there's a thing in the first lien position, which hopefully is Fannie Mae. And then the second lien position is some other investor that's helping you out with maybe the down payment, things like that. I've seen that on occasion. So just
Or a
some
hard
ideas.
money loan.
Oh, yeah.
Yeah.
Whew. So that's some fast paced stuff, hard money loans from what I've heard.
Yes.
I haven't gotten into that, but maybe one day. With premium pricing, that's really just talking about having a higher interest rate, right?
Yes.
So it's like, hey, I'll accept this higher interest rate if you give me some money for my closing costs, for example. That's a lot of the times what loan officers will utilize premium pricing for when we start getting into creative financing. You come to the table, you want to buy this house, but you're a little shy on your closing costs. Well, hey, guess what? You can go ahead and get a higher interest rate, and then the lender will go ahead and give you some money to close that gap between what you're missing in your closing costs versus having enough for your closing costs, right? So that's really what I got out of premium pricing from the courses I've taken recently, where it talks about some of that creative financing. And so Fannie Mae talks about that here, how they accept that, and how that's okay as long as it fits with all of our other guidelines that it references here, these other sections, you know, minimum reserves, interested parties, grants, lenders, and community seconds, things we've already talked about previously.
Yes.
Ooh, private transfer fee covenants.
Mhm.
Transfers aren't super common. That's why not
Popular,
many
right.
people talk about it. But in case you're in a situation where you have to do that, this is just talks about Fannie Mae's rent like interpretation of what that looks like. So they are pretty strict about some of it because of what it could mean for them when they buy that loan. Might have some things that it doesn't deem acceptable, things to that effect. It's just covering what are those minute details that we need to keep in mind.
Fannie Mae will not purchase a loan with PTEC if it was created after February 8, 2011. This is a charge that the real property buyer contractually required to pay a private property, example, an HOA. So basically, like if you have an HOA and you have another transfer fee or you make another payments with them, that's something that is an exemption for Fannie Mae. You got to get that cleared up before the loan gets transferred over.
Yeah, just know it can get a little messy sometimes depending on your situation, but we take it one step at a time and then we figure out what can we do, right? That's the big thing. One step at a time and what can we do right now to get us to where we need to go to the next step. I think if everybody takes it that way, even these things won't be so frustrating. It's just having the patience, trying not to get frustrated. I think that's the toughest part when it comes to these types of things.
Age of loans about 6 months old. So Fannie Mae loan must be no more than 6 months old, measured by the first payment date to the purchase ready. So for them to consider the age of the loan, it has to be at least 6 months.
That tells me, oh, okay, so in the second market, you're going to buy it after 6 months. Okay.
Yes.
That's minimum 6 months at least. It might be later, but minimum 6 months because, oh, you got to prove this is what it is. And we're going to give you half a year to do that. Also, they talk a lot about MBS loans. I know we talked about in the past mortgage-backed security loans. So that's where they pool it all together, right? And buy those. They talk about that in here too, as far as that reference. Property value for loans sold more than 4 months from note date. It has a quick note about that. For loans that are more than 4 months old from the date of the loan date of the note to the date the loan was sold to Fannie Mae, the current value of the property cannot be less than the original value. That's important. Okay, so obviously something fishy's going on if that doesn't happen. If the lender is unable to warrant that the current value of the property is not less than the original value of the property, loan is not eligible for sale. Fannie Mae by the lender except on negotiated basis. I'd love to be in the room when those negotiations go down to see like, what do you got to say to get Fannie Mae to go like, oh, okay, all right, fine. I see you're not doing what we want, but we'll take it. I'm really interested to see how that looks.
Season loans.
What you got?
1 year or more. So they wanted for a loan to be seasoned, it has to be considered 1 year or more based on the first payments. When you drop that first payment, 1 year from there.
Yeah, I think they should have called it like marinated. I think that would have been a better term as opposed to season. Like season, I can just do that in a second, right? But marinated, that takes time.
Or
and
bake
this is, that's the same with the money, right? When we're talking about when you deposit unsecured funds into your bank, it's going to take like 2 months, 60 days.
2 months season.
Boom, now it's seasoned. I'm like, guys, that's marination. Like it's going to take, anyway. I digress. So that's season loans, just to give you an example of that. And then it talks about the requirements of what a season loan looks like.
Basically, no late payments.
Yeah, oh, that's a big one. Yeah. If you're shooting for a good credit score, then this shouldn't be an issue already because 35% of your credit score is determined by payment history. However, in case it is a problem, just know you got to have some pretty stellar loan payment history for Fannie Mae to be like, oh yeah, we'll take that. We will buy that. So I think that's more of a relationship between the borrower and the lender. So as the lenders are trying to create their rules about what they can do to sell their loans later to Fannie Mae, that's what I think dictates a lot of those rules are these guidelines here in Fannie Mae. So that's not so much for the borrower as it is more so for the lender.
Modified loans that are legally modified after the loan closing, a way that change any of the loan terms or attributes reflected in the original loan. So that's what a modified loan are. Changes to original loan amount, either the interest rate, final maturity, the product structure, are not eligible for Fannie Mae. I think our last episode, we talked about the modified loans if it's within like the contracts. If it's in the contract, like the arm saying, like if you have an arm and then you said, I do plan to refinance it to a fixed rate, they will accept that. But anything after the contract has been settled and signed, they're not going to accept, especially big differences of the interest rate or final maturity or product structure. Those are big changes. So they're like, whoa, that goes against our cookie cutter.
That is exactly what it is. Because like, look, you already said it fit. You had fit
Right.
within the restraints we set. Oh, but later, oh no, actually, we're going to add an extra arm to that cookie, that gingerbread man, or
Right.
maybe some more chocolate chips over here. And it's like, well,
Right.
no. That's
No.
not what we signed up for, guys. That's not in
Yes.
the contract, right? If it's in the contract, that's different. They can't fight that because look, before they
Right.
accepted it, they were like, here's the deal, guys. Maybe that was
Right.
negotiated. I don't know, something, but it was there before they bought the loan. So that they can't argue that. But yeah, modified
Yes.
loans. If you modify, just know that there's probably going to be issue if Fannie Mae got it in the beginning. So if you're going to be modifying, I recommend maybe going in the non-QM direction in that case. Maybe there's something going on that needs to be modified, and no malintent, guys. I'm telling you, that's another reason why they're so against this, is because it could be where somebody's losing. Okay. And that's not how
Right.
good business is. Everyone has to be winning in some form.
Yes. Agree. I love it.
Modified loans. Careful, guys.
Yes.
And it talks about the products here: converted arms. It says a
Yes.
yes or a yes. And so owned or securitized by Fannie Mae prior to the time of modification is one of the column questions. And the other one is eligible for delivery to Fannie Mae after the modification. So most of these are no, as we just discussed, but some of them are yes, like the converted arms. If it was through Fannie Mae, then okay, yes, because it's an arm. So eventually it's gonna change, right?
Right.
So that's how that needs to be. But everything else you can see, no, not associated, borrowed principal, curtailment, and recast over the remaining term. Curtailment, by the way, I had to look that up.
I had to look
It's
it up
just
too.
right. I'm just like, what are you guys talking about? That sounds like the end of a
Yes.
fancy suit. You know what I'm talking about? The top. Anyway, curtailment.
Yes.
So what it is in layman's terms is basically like you paid it early. You finished
Yes.
paying it early. Oh, look, now you have a curtailment because this wasn't the initial expectation. You were ahead of the game. So now you have a
Yes.
curtailment. That's that value there that you created. That's the curtailment. So I
And
wish
that's a
we
good,
just
I
call
like
it
that word.
leftovers, you know? Yeah,
Yes.
yeah. Some
And
leftovers.
that's like, like we talked about in a previous episode too. Like if you have a 30-year mortgage, if you're making biweekly payments, it makes it look like you're saving interest, what makes it look like a curtailment. Or if you're making additional payments, every time you get your taxes, you drop an extra payment. That's looking like a curtailment. You're reducing that amount. So you're paying it earlier than that fixed 30 years that they had set up.
Right. You pay it before the 30 years is up. And of course, it
Mhm.
talks about that curtailment a little bit more, but I think we have definitely covered that pretty well. I think at this point, you could
Yes.
probably use it in conversation at the water cooler and look impressive.
Yes.
You pay that ahead? Oh, man, you got a curtailment? Non-standard, something that I'm very familiar with in the insurance industry, non-standard payment collection options. I'll go ahead and lead the charge on this one here. So
Yes.
basically, it's where kind of like what I was just talking about, where you're making payments that aren't in the norm. However, this one is in more of the negative direction. So you're not actually paying it every month. You've decided, I'm going to pay every quarter. You know? So
Oh,
it's like instead of paying monthly, like Fannie Mae would expect you to do,
right.
the lender is like, oh no, that's cool. Just pay us every 3 months. That's fine. You do lump sum 4 times a year, you're good. The math ends up being the same.
Right.
And so that's why they're not opposed, the lender, but maybe Fannie Mae is. And so these are why some of these would not be acceptable, because Fannie Mae wants to see that, hey, we're getting that monthly. And if that's
Yes.
not the case, that needs to be built into that contract. We need to understand that before we get involved with you. Because it says the agreement must not impact terms and conditions, the mortgage note, nor the reporting or remittance of payments to Fannie Mae. So they're very strict because obviously they bought the loan. Now that's the money they need to get back.
Just make sure you have that on the contract prior so Fannie Mae can accept it.
Yes. And make sure you're prepared for that too, because
Yeah,
that can be
that's the
very
drop.
different from, everything else you do in life. There's annual, there's monthly, but there's never been other things like that normally. And
Yes.
with insurance, every 6 months, something like that. And it's funny that it's non-standard. So it's not standard, I guess they'd say.
It's important that they understand the ability to repay, because you may be financially ready to pay to purchase a home, but you may like you say, you may have your credit card ready, but do you have the other aspects, other seven available ready as well? And to know the difference between a qualified mortgage and a non-qualified, because ultimately when the loan is sent out and the loan is sent out to Fannie Mae, and for lenders and brokers to get their money back, they want to make sure everything is good until, or if Fannie Mae comes back and say, hey, this is not ATR, this is not QM, the broker is going to have to pay that loan back.
when it comes to the ability to repay. Because that was one of the biggest takeaways for me
Yes.
was like, hey,
Mhm.
why is this important? The whole liability of the lender versus the borrower and where the problem really goes to, like who's paying for this situation. And I think also that there are very stringent ideas about what's acceptable as a loan, right? Like
Yes.
not so much the situation, because like you were saying earlier, right? It's like, hey, yeah, I can afford it in one aspect, but can I afford it in all of the aspects, right?
All of
Am
them.
I going to be, what's the term here? House poor, right?
Right.
That means I got the house because I could, but now I'm living a life of misery because I'm trapped. All of my money goes towards my house. I can't do anything else. I can't
Right.
go on vacation. I can't give too many
Right.
gifts. I can't, I'm very, everything is extremely strict, if not impossible, without doing extra things. I think that's one of the things to keep in mind as loan professionals. We have to talk to our clients about that. It's like, again, at the end of the day, as I said earlier, they're making the decision, regardless if it's good or bad, in our opinion. However, something to keep in mind, if you want a life of abundance, then you got to also make margin, right? Or make room
Yes.
for other things that life will entail. That's important grasp because this kind of shows us why some of that's important, like why HOPA exists, for example, or why Fannie Mae only wants these certain types of things, because it's most likely that people will pay those things, right?
Right.
Believe me, if they had to pay for food versus their home, they're gonna pay for food. So
Right.
it's like survival today versus survival in 30 days. Obviously you pick and choose your battles. But yeah, no, that's everything here. So to kind of land the airplane, thank you guys so much for
Thank
joining us on this journey.
you.
A little bit of loan knowledge. I'll put all of our
Yes.
information around us right now. My name, of
Yes.
course, is David Dowd with David James Investments.
This is Bathsheba with Groves Capital. And I'm so excited. Thank you guys for joining us. I hope you learned something and we love doing this and we appreciate you guys.
That's right. So have a great day. We'll catch you on the next one. Be blessed. And until next time, guys, take care.
Bye bye.